Customer profitability analysis is an application of activity-based costing principles, but using it in a slightly different way to what you would have seen initially. Now, activity-based costing in its purest form very much is used within manufacturing businesses, although it can be used in non-manufacturing environments, but it is traditionally used in manufacturing businesses to work out the cost of the products that we produce. Now, customer profitability analysis, sometimes abbreviated to CPA, is going to use the principles of activity-based costing, so the idea that there are activities and cost drivers, but this time we're not going to focus on the products being produced. Rather, we're going to focus on the customers that we, if you like, serve as a business. Okay, so the customers that we look after, that we provide output to. And so that's all customer profitability analysis is. It's using ABC principles, but this time we're not focusing on products, we're focusing on our customers. Now, what a lot of businesses will find is that not all customers place equal demands on the business. And so, speaking from experience, I've had client management roles in the past, and we used to look after a real large range of clients in terms of the size of the clients, in terms of sort of the custom that we got from them. And it would be, I suppose, easy to always think that the biggest customers are the best, but the biggest customers often bring with them very big demands that they place on the business. And them demands could be things such as requiring bigger discounts, but also requiring a much higher incidence of the activities required to keep these customers happy. Likewise as well though, you can have some customers that are almost too small. So they are so small in their scale that they maybe place very few orders, and when they do, their order sizes are very small, which means once again, actually the effort we have to exert to keep these customers happy really doesn't, I suppose, justify the fees that we charge. And simply put, not all customers place equal demands on the business. And what customer profitability analysis will do is it'll actually highlight which customers are the most demanding, which are the least demanding, and maybe some which are somewhere in the middle. Now, of course, having this information is going to be massively, massively useful. We may find some customers are much more or less profitable than what we would initially expect. And again, we can then use that information, hopefully, to make improvements. So for them customers that are less profitable than what we'd expect, we could have a look at that and say, right, what is the reason for this? Is it because there are certain activities where they are super demanding? Well, can we reduce the instance of these activities? For example, if we're talking about the small customers, do they order in really tiny order sizes? Well, can we find a way to encourage them to place bigger orders? Or actually, maybe it's the biggest customers, and maybe they just never pay us on time, so always chasing the debts. Well, how can we maybe encourage them to pay us more promptly? And so customer profitability analysis will really give us that clear picture that we need as far as our customers are concerned. Now, you may have come across the concept of Pareto analysis in your previous studies, and it's often referred to as the 80-20 rule. Now, this is often evident actually when an organization analyzes its customer base. And so often what they'll find is the majority, so the 80% if you like, of their profits, in some cases more than this, will be generated by actually just a small number, i.e. 20% of their customer base. And in fact, the other 80% of their customer base maybe only make us marginal profits, but indeed some may be loss-making. And so again, this will be really useful if we can highlight that nucleus of customers who generate the majority of our profits. We know they're a safe bet. We know we need to look after them. We need to keep them happy. But then, of course, we can focus on the other 80% of customers and find out where we can make improvements. Okay, so Pareto analysis, the 80-20 rule, very common phenomenon and often observed, if you like, by businesses as far as their customer base is concerned. So as we said, customer profitability analysis, really, really useful, again, to help us make decisions. Now, then decisions could be, can we find ways to serve customers more efficiently? So that might be a case of saying, right, okay, well, maybe there's certain areas where we can reduce our costs based on the activities and the cost driver information. Or it might help us rationalize which customers we target. Now, it simply isn't the case that if we worked out via customer profitability analysis that a particular customer group was unprofitable, we're certainly not saying we shouldn't look to serve these customers. What we are saying is we need to look to make these improvements going forward, but it might be we dedicate more of our time to trying to attract the more profitable customers compared to the least profitable, particularly if that least profitable if you like, segment or section of customers, we can't find a way to make improvements there. Or maybe it's a case we work out all this information, we see how demanding these customers are, and maybe we just alter our pricing strategy based on these types of things as well. So the key thing is it just provides us better information on which to hopefully make really, really good decisions. And that could be price, it could be cost-based, it could be a mixture of many different things. What a business's management accounting system should be capable of doing then, and it would be essential it did this if we wanted to practice customer profitability analysis, is be able to produce a report for us on a customer by customer basis. Or in some cases, it might be the case that it's a particular category of customer. So maybe customer A represents a typical type of larger customer, and customer B represents a typical type of smaller customer. Now, what a lot of businesses have no problem calculating is what we call the gross profit or the gross margin on their customers. And that is simply the difference between the revenue we charge them and the cost of producing or providing whatever it is we sell to our customers. So if you're a manufacturing business, what do we charge them for the products versus what's it cost us to make the products? And in terms of your cost of sales, there'd be typical things like your direct materials, your direct labor, and maybe other things that it's easy to estimate as far as the customers are concerned. Or if you're a service style business, again, it's the revenue you generate against the cost of providing that service. If you're talking something like an accountancy practice, it would be things such as what you charge your clients to produce the accounts and the tax returns, less the cost of maybe the accountant's wages of actually producing these various pieces of required sort of financial reportings and so on and so forth. Now, the example we see here on screen, again, very much, it's kind of under the guise of a manufacturing business. But what we can see here is we've got customer A generating a gross profit of 600,000, much, much larger than the one generated on customer B, because customer B is much smaller. They only generate a third of the revenue and actually only come out at a gross profit of 175,000. And as we'd often expect in this case, due to various factors, customer A, we make better gross profit margins on customer A, 40%, and slightly worse gross profit margins on customer B, which is 35%. And just as a reminder, if you're working out a gross profit margin, it'd be your gross profit divided by revenue times by 100. However, you'll then see below gross profit, we've got all these other activities and costs associated with them. And so actually to serve these customers, to make sure we're meeting their requirements, we have to process their orders. So we've got order processing costs, we've got to do some packaging, we've got to do some delivery, and we've got some credit control costs in there. Now, of course, in reality, there'll be a much wider array of costs than what we see there, but this is really just to prove a point that we're talking about in terms of the demands different customers can place on the business. Now, what you'll notice actually, once we've used our activity-based costing principles to charge the processing, packaging, delivery, and credit control costs to these two different customers, actually we can see customer A is much more demanding in respect of these different activities. And so we'll see their gross profit drops to a net profit. So this is the true profitability on this particular customer, which drops it down from 600,000 down to 280,000. And that's generating a net profit margin of 19%. And again, if we wanted to work out that net profit margin, it's just the net profit. So for customer A, the 280,000 divided by their revenue of 1.5 million. And again, we times that by 100 to get it into a percentage. So you see there's a drop from gross margin to net margin of 21%. Do the same thing for customer B, the drop is not as nearly substantial. So they see a situation where their gross profit of 175 drops to a net profit of 120. So it's a reduction in their margin, which actually comes in at a much smaller 11%. And that drop there of 11% compared to the 21 says actually in respect of all these other activities, packaging, delivery, credit control, and so on and so forth, they are much less demanding. So even though customer A makes us a bigger overall profit when we look at net profit, which is fantastic, obviously they're a much bigger customer. And so when we look at the profit margin side of things, which are comparable figures because they're percentages, so relative figures can be compared across different customers, in this case of different sizes, we can actually see customer B is the better performing customer. Not in absolute terms, because it makes a lower net profit, but in percentage terms. So we're getting better bang for our buck when we look after customer B. And this is what activity-based costing used under this guise of customer profitability analysis will help us determine. Let's take a look at an example for customer profitability analysis. And so within this example, we're provided with a range of statements, and we need to determine which are true or not true in the context of using customer profitability analysis, but also combining that with Pareto analysis, that 80-20 rule. So let's have a look at these statements. So the first one says, Pareto's analysis will imply that 80% of customers do not generate profits, and it is implied, therefore, to stop serving them through a systematic approach over time. Okay. The next one says, for most businesses, when a customer profitability analysis is performed, it is not unusual to find a Pareto curve exists. So it's not unusual to see that 80-20 rule in action. Statement 3 says, in Pareto's analysis, for the customers falling in the 80% group, one of the factors identified is small volumes or order size. Remember, the 80% group are the ones that are unprofitable. It says they are not profitable to the business due to the high production batch costs and order processing costs. And finally, it says one way of effectively dealing with such customers, the ones that order in small volumes and so on, is actually the introduction of a third-party wholesaler, if possible, in the supply chain. So actually, instead of us producing in small batches and processing small orders, we actually bring an extra element into the supply chain, not necessarily us, but we could sell to a wholesaler, which would still allow us to produce in big batches, and then they could deal with the smaller customers by selling that off to a range of smaller customers. And it essentially says it will reduce the cost for us. So what do we think? Let's have a look then. So first of all then, statement 1 is not true. Okay? Now there's an element to this which is true. So the first element, when it says the analysis will imply that 80% of customers do not generate profits, fine, okay, I suppose that is the definition of Pareto analysis when applied to this particular scenario. However, the implication isn't necessarily that we should stop serving these customers through a systematic approach over time. The idea is with the unprofitable customers, we actually use the information we get from customer profitability analysis to find ways in which we can serve them in a profitable way. It's only once we've exhausted all possible options in this respect that we consider making what is a long-term strategic decision to no longer serve that particular customer or segment of customers. Okay, that would almost be a final action rather than the purpose of customer profitability analysis is if we identify an unprofitable segment of customers, we find ways to make them profitable. Now, that won't be possible in every single instance, but certainly that is the first port of call there. So not true for statement 1. The second one is true. Okay, for most businesses, when customer profitability analysis is performed, it is not unusual to find a Pareto curve exists. Absolutely, that is true. The next one is also true. Okay, what we often find, the unprofitable customers, they are not exclusively the small customers, but a lot of the time that tends to be the case, because if they're placing small orders, it means actually we've got a lot of things to do and it doesn't allow us to take advantage of economies of scale. If we only have to produce in small batches, deliver in small batches, process small orders, it takes away that sort of scope, if you like, for scale economies to be achieved. So therefore, the demands they place on the business relevant to the revenue we generate over a small number of products or services being provided actually often leads to them being unprofitable. Now, that doesn't mean large customers can't be unprofitable, but they have to be super demanding relative to small customers for that to be the case. And the final statement is also true. Okay, one good way or one beneficial thing for us as a business is instead of serving these small customers, what we could continue to do is still produce in big batches and process large orders, but we do that for a wholesaler, so like an intermediary between us and these small customers, as opposed to dealing directly with these small customers. So therefore, that would mean we could still produce in big batches, place a single order with our suppliers to produce a large number of products, and therefore it would allow us to maybe make some efficiency savings. I suppose one drawback with that would be we'd probably have to charge the wholesaler a lower price than what we could charge the final customer. So there'll be a reduction in that respect in the margin, but hopefully the efficiencies we generate by doing this would more than outweigh that reduction in the margin, or if you like, the lower price we'd have to charge the wholesalers. Because at the end of the day, they still need to make a profit.